Welcome to FT Advisor On Air Live. Today we're going to discuss guaranteed retirement income options post-April 2015. Today's webcast will feature a series of presentations on the options today, risks to retirement income, and how solutions can be blended to make sure your clients don't run out of cash. You can also ask questions of our panel of 3 pensions experts by using the comments box on this webpage or tweeting using the hashtag FTAOnAir. Before the debate kicks off, let me introduce Emma Ann Hughes, Editor of FT Advisor, with a quick overview of today's guaranteed retirement income options.
For retirees, the 2 big unknowns in life are how long income will need to last and what returns they will be able to get from their pension money. What is known is essential spending, food, accommodation, heating bills, etc. do not disappear when you decide to exit the workplace. However, there are few sources of retirement income that are regular and guaranteed for life. In the UK, there are 3 main sources of guaranteed income, a choice that boils down to who do you put your faith in, politicians, your employer or an insurer. Let's start with the state pension. MetLife analysis of government data shows the average retired household receives around 48% of its income from benefits, with the state pension making the biggest contribution of an average £8,750 per household. Currently, the basic state pension is a regular payment from the government that you get when you reach state pension age. To get it, you must have paid or been credited with national insurance contributions, and the most you can currently get is £115.95 per week. Under the current Conservative government, the basic state pension increases every year by whichever is greatest of the average percentage growth in wages in Great Britain, the percentage growth in prices in the UK, as measured by the Consumer Prices Index, or 2.5%. However, a new flat rate state pension is set to be introduced in April 2016. Currently, the DWP states the full new state pension will be at least £151.25 per week. According to Hargreaves Lansdown, 2 million retiring pensioners will miss out on getting the full state pension, which is 45% of those who will reach state pension age between 2016 and 2020. What is clear is people often have higher expectations of the lifestyle they expect in retirement than the state pension can actually deliver. A Prudential online poll of 581 adults found 1 in 5 pensioners heading back into the jobs market, with the need to boost retirement income cited by 56% of those surveyed. Another guaranteed source of retirement income is a pension from a defined benefit or final salary scheme. A defined benefit pension scheme promises to pay out an income based on how much you earn. Unlike defined contribution pensions, the amount you'll get at retirement is guaranteed and will be paid directly to you. This type of pension typically uses index linking. Protection is usually capped at 2.5% a year, although in some cases it is linked to inflation measured by the Retail Prices Index. But while final salary pension schemes leave an employer obliged to meet the pension promise, regardless of how underlying investments have performed, this does not mean an employer may be capable of meeting the promise. In terms of the funding crisis facing DB schemes, research from PricewaterhouseCoopers has shown aggregated deficits quadrupled last year. For those that failed to deliver, the Pension Protection Fund was established by government to cover schemes that failed from April 2005 onwards. The PPF ensures that pensioners continue to receive the full amount due up to a cap of £36,401.19 a year at age 65. Finally, let's turn to annuities. While there is much talk of an annuity being a one-off, irrevocable decision, post-pension freedom, it is no longer as straight cut as this. Just before this year's budget, Chancellor George Osborne announced that 5 million retirees who had traded in their pension pot for annuities would be able to cash in their policies for a lump sum. However, as of yet, detail on how an annuity resale market would operate has not been forthcoming. So let's turn to the main advantages and disadvantages of annuities as they currently stand. If a state pension is a promise from a politician and a defined benefit pension is a promise from your employer, then an annuity is a promise made by a financial services provider. The main advantage of guaranteed annuities is the income is determined at outset and guaranteed for life, meaning all of the risks are passed over to the insurance company. On the flip side, the clear disadvantage is you've handed control of your future retirement income pot to an insurance company. For a guaranteed annuity paid for life, the The main difference between providers will be the rate offered. Depending on whether the individual qualifies for an enhanced annuity or not, the rate offered may fail to deliver a generous income level over the course of some individuals' retirements. In contrast, investment-linked and fixed-term annuities offer greater flexibility but carry risks. In the case of the former, the investments may fall in value and thus provide a poorer income level, and in the case of the latter, the amount available at the end of the term may not provide the level of income desired if annuity rates have fallen, for example. In terms of inheritance, if you take your pension as an annuity, you can only leave it to someone after you die if you've chosen a joint or guaranteed annuity. In terms of current use of annuities, the latest statistics from the Association of British Insurers revealed almost £2.5 billion worth of payments have been made to customers in the first 3 months since the new pension freedoms came in. The trade body's figures for April, May and June showed that £990 million has been invested in around 17,800 annuities, making the average fund invested just over £55,600. So clearly, despite headlines heralding the death of annuities last year, there remains a place for this product.
So, here to give their views on the value of a guarantee post-pension freedom are our panel. I'm joined by Gavin Casey, Distribution Director of Aegon, Malcom McClean, Senior Consultant at Barnet Waddingham, and Chris Dames, Director of Sevello Financial Planning. So Gavin, if we can start with you.
Certainly.
How do you think the state pension should be viewed in the new landscape?
Definitely as a bedrock for some of that essential spending that we've just been hearing about. Of course, from a planning perspective, the questions over how much individuals are going to get and some of the confusion about that will make it difficult to know for certain unless you get a calculation through to actually understand what pension you're going to get for a planning perspective. But once in payment, a bedrock for essential spending.
Okay, I mean, Malcolm, do you have any views on this? Should the state pension continue to be a central part of the retirement plan?
Yeah, increasingly so, I would say. For many people, the state pension may be the only guaranteed income stream that they have during their retirement years, because if they've got a defined contribution private pension, they may, of course, take that in other ways than a clear income stream. So very important that people actually understand the state pension and where we're going with it. Now, we do have a new so-called single-tier state pension starting next year, but it really is not quite the panacea that the government's made it out to be. It's been described as a more generous, flat rate, easier to understand state pension. It's actually none of those three in the immediate future. Because there are things like contracting out deductions which are made from it, and an increased requirement to have 35 qualifying years of national insurance as distinct from 30. So what I would say to people who are planning their retirement is to find out just what state pension level they are heading for in the coming years and plan around that. And do not assume that they're going to get the full rate of £150 a week. It may not be that. And the last thing we want to do is people sort of sleepwalking into poverty because of this, because they've spent all their private pension saving or not saved enough, depending on a particular level of state pension, which they're not going to get. But it is increasingly important.
Sure. Okay, and that's obviously the state pension, but in terms of industry-provided solutions, we've had a question from Damien Fay of Money to the Masses, who's asking about consolidation, I think specifically with regards to annuities, and he's saying, with big deals occurring between annuity specialists, is there a danger the industry is going to be dominated by a small number of players? He points out that he doesn't think that's going to be good for innovation or for consumers. Chris?
Yes, it's a really interesting question. So I think what we're seeing is a couple of things. Firstly, there's potential for annuity providers to consolidate, that may occur, but what you're also seeing is new products coming into the market. Now, I believe that if you've got a healthy marketplace with a bunch of different options for individuals to use when they approach retirement, that's a good thing, because what it will do is make sure that the annuity providers that are out there remain competitive. In our experience with clients that we work with, annuity providers in the new world have had to become more competitive to retain the sort of ground that they've continued. There's still a demand for annuities. I mean, we heard it in the video that people are still looking for, to a certain extent, a level of guarantee.
Okay. And there's another question we've had in from Patrick John Ring via Twitter, where he was talking about guaranteed drawdown. Obviously, we're seeing a raft of these new products coming out, but is it any more than another term for a good value annuity?
I think they are good value, but I don't think they would be described as a good value annuity. They sit between an annuity and a naked drawdown policy. They're absolutely in the middle. They provide the security of annuity. They provide some of the flexibility of a drawdown policy, but at a cost. So I think they shouldn't be viewed as an annuity. They should be viewed as a guaranteed income stream that sits within the middle of those two options.
Okay, thank you, Gavin. Earlier, Emma Hughes, editor of FT Advisor, was able to give us this quick overview of the risks your client's retirement income faces in 2015.
Events in China last month caused the FTSE 100 to suffer its biggest one-day fall since 2011. Less than 6 months since savers were granted greater freedom to choose what to do with their pension pots, Black Monday painfully illustrated to some of those who selected drawdown that greater freedom comes with greater risk. It is vital when considering different retirement income options to understand the risks faced in retirement and the threats to the value of a pensioner's pound. In life, timing is everything, and interest rate risk and market risk is the possibility of encountering low bond returns and high annuity prices at the time you need to get an income. Low interest rates depress the coupons paid out by bonds, and if interest rates rise, the market value of the bonds will decline. Further, low interest rates usually lead to an increase of the price of annuities or an investor receiving a lower payout for the same amount of principal. For instance, Russell Investment reported in the 2 months from November the 1st, 2008 to January 1st, 2009, which was a period of declining interest rates, the payout from an immediate life annuity for a given amount of principal and decreased by 10%. Giving participants the option to invest in a short-term bond portfolio or drawdown may be the best way to help them avoid locking in low interest rates for the long term. However, this approach comes with its own risks, as seen by the recent events of Black Monday. The growth of flexi-access drawdown means many savers are now shouldering the investment risk themselves. As a result, market downturns can have a painful impact on the value of savings and consequences for how much income people can afford to take in the future. So let us turn to those who have opted for a guaranteed retirement income, such as an annuity. In the context of retirement, those who have chosen a retirement income option will face inflation risk unless they have chosen wisely. Inflation risk refers to the notion that price increases can eat away at one's standard of living. Back in 2012, Aon Hewitt asked people to calculate the following sum to see if they understood inflation. Savers were asked to calculate the decreased buying power of £100 after 10 years of CPI at 2%, the Bank of England's target rate. The answer was £20. Just 34% of people polled were in the correct range for the answer of £10 to £25. It is vital that inflation risk is considered by anyone wishing to maintain their standard of living throughout retirement. Advisors and their clients must grasp the approach taken to keeping up with inflation. Some insurers carriers do offer annuities where the benefit is linked to the consumer price index, but the trade-off is usually a lesser amount of initial annual income. However, a lesser amount up front may prove worthwhile for those who look forward to a long retirement. This brings us to longevity risk, which is the risk of living well beyond one's life expectancy in retirement. This can put a great deal of strain on a retirement portfolio. In 1952, life expectancy for a 65-year-old woman was 15.4 years and 12 years for a 65-year-old man. In 2012, life expectancy was 23.9 years for a 65-year-old woman and 21.3 years for a 65-year-old man. Planning for the lifespan instead of for the moment has significant consequences. Within longevity risk, there is healthcare risk, which is the possibility of having unexpectedly high healthcare expenses in retirement. There is a real risk in retirement of unexpected and large out-of-pocket expenses that can decimate a retirement portfolio. For example, the development of a chronic illness could cause a retiree to need expensive long-term care. According to an International Monetary Fund report, From 2012, the substantial costs of ageing already faced by society provide a useful starting point to assess the magnitude of longevity risk. The most common measure of ageing is the old age dependency ratio, the ratio of the population 65 and older to the population 15 to 64. Over the period 2010 to 2050, old age dependency ratios are expected to increase from 24 to 48% in advanced economies and from 13 to 33% in emerging economies. These numbers are subject to considerable uncertainty, not only regarding longevity, but also with respect to developments in fertility. Under the demographic trends expected by the United Nations, and with a 60% replacement rate, the aggregate expenses of the elderly will roughly double over the period 2010 to 2050. In the baseline population forecast, and with a 60% replacement rate, the annual cost rises from 5.3% to 11.1% of GDP in advanced economies, and from 2.3% to 5.9% of GDP in emerging economies.
So this is obviously a critical area for advisors. So Malcolm, how can advisors make sure that their clients are aware of the risks?
Well, there are several risks, of course. The longevity risk, the fact that most people, in my experience, underestimate their longevity. They don't appreciate just how many years they have left, quite frankly, and there is a real risk of them running out of money. So that needs to be explained. Now, I'm not suggesting that advisors give individuals a date of death or anything like that, but I mean, at least give them an indication of on average how long they might expect to live, so that they are aware of the need to make this money spin out. So that is one very clear risk that comes out of this. The other risk is that the person may not actually appreciate the tax implications of what they're doing, and they need to be a bit careful on that. And thirdly, and perhaps finally, there is no question that at the moment there are a lot of people out there, fraudsters, who are seeing the pensioner population, new pensioners or people aged 55 and above, as being people who will have access to large sums of money, potentially large sums of money, and therefore are a ready target for the sort of scams that are around, people being urged to transfer the money out of the country and things like that, which really backfires very badly. And I've met several people who've lost all their pension savings through this, and it's a very distressing thing to happen to any individual.
Okay. And you mentioned longevity risk there. I think something that contributes to that is the investment risk that obviously Emma referred to, what's happened in China over the summer. Yeah. Is it going to be a case, Chris, I'd be interested in your view on this, but there's going to be a lot of newcomers to drawdown since April who have suddenly been thrown into actually what's been a disastrous market, which is going to have a massive implication for how long their funds can last.
If you're in the market now as an investor, it's a particularly tough time because it's worrying for most people who haven't got the background in making investments over the long term, and as humans we tend to be particularly short term, so something happens and we react to it. The way that we find works particularly well with our clients in terms of helping them understand particularly the longevity risk is visualising it. So we use cash flow management tools within our business that shows, if you follow a particular path at 69, you're going to run out of money. You're going to be in a situation where it's going to disappear. So we need to amend that plan so that we're in a position where it's going to last a lot longer. So making a client's plan tangible and visible really works for us, our business and our clients.
It's very important actually that you get this right when you're explaining all this, because the other risk as well of people trying to manage off a totally inadequate level of income and living in virtual poverty going forward. So it really is a case of getting this balance right, and it's very, very critical task for all advisors.
Yeah, it's interesting, Malcolm. Some of those visualisations are quite scary when you put them on paper.
Well, the other thing is, of course, it's really scary when you consider the example that you've just given about what's happened in the markets. Our research tells us that over a 30-year time period, a positive return in the first year of plus 20 means that you've got virtually no chance of running out of money. So you need one great year. But you get minus 10%, which individuals are already down minus 10% since April in many, many portfolios. That increases your risk of ruin by up to a third. So 1 in 3 might run out of money based upon those sort of market conditions. And it's really important that individuals understand what those risks are, using those tools, up front.
Yeah.
I mean, Gavin, just sort of related to that, we've had a question from Martin Dodd, which, while we're talking about consumer understanding, not just of the risk of the actual products, he says since income drawdown has become much more popular, more people want to use flexi access options. But what concerns him is that the complexity of the key features documents and the client illustrations attached. How much of an issue do you think that is, and what do you think could be done to make the practicality of drawdown easier for clients to understand?
I think many of the providers and also many advisors are working really hard to explain exactly how these options are going to work and what the implications are. As an example, we've all had to start delivering retirement options packs in a completely different way as of about February of this year, as I recall. And we're starting to see that the information is much clearer and much more understandable for individuals. But I think we've all got more to do on this.
I think also the FCA's review, FMAR review, will have an impact on that, because if the FCA are considering how to make advice and financial planning and savings accessible to all, one of the things we need to make less complex is the way we communicate. So it'd be interesting to see what the FCA come out on that.
Okay, well, hopefully some clear communication here, because here is the third and final part of the presentations recorded earlier. This one features Gavin, who will cover how you can now blend retirement income options.
Income needs can vary over time. Many people now phase into retirement, so they will need to gradually replace their salary with income from retirement savings. One-off expenses can have an impact, particularly early in retirement. Bereavement can unfortunately happen, and many people lose their spouse during the earlier phase of later life. Health is an important factor. Illnesses like cancer and dementia can have a significant impact on lifestyle and income needs. And while divorce rates have fallen in the last 10 years in the UK, they've risen for those over the age of 60. The over 60s boast the fastest increasing demographic for marriage in recent years. Modern retirement income strategies must have the flexibility to evolve with client needs. Often a saver's attitude to risk will be different, depending on how they plan to spend that income. For example, essential spending covers the ongoing cost of retirement. Many savers will be prepared to sacrifice some growth potential in return for an element of security for this part of their income. Discretionary spending covers the regular nice-to-have expenses. Savers may well be prepared to take on more risk in return for better growth and income potential with this portion of their savings. We're seeing a significant increase in the use of what we call blended or hybrid solutions to meet these different types of income needs. The benefits of this hybrid approach are essential spending secured for life. Traditionally, this is done via an annuity. Other sources of fixed income include any state pension or benefits from a DB pension scheme. The worst case scenario here is that we have to cut back on discretionary items. Secondly, additional funds are invested for growth and could improve the retiree's income or legacy savings in the future if their investment does well. And finally, the individual maintains complete control over the investment of discretionary funds, so they can respond to changing circumstances and vary their income. For example, once somebody who's phased into retirement stops working completely, they may need to buy additional secure income to cover essential costs. However, there are some notable challenges with this approach too. If investment market conditions are excellent during retirement, our retiree might wish that they had secured less of their income and had benefited from a larger proportion of their funds invested in flexi access drawdown. Conversely, if market conditions are poor, they may have to curtail some or all discretionary spending and may wish that they had secured more of their income. A key question for advisors and their clients is, what's the best way to secure that essential spending requirement? You can do that in a number of ways, and we expect to see the two most common options to be through a traditional annuity or secure drawdown. The key is to get the balance right. Let's take a scenario looking at how blending could work, either a traditional annuity or secure drawdown. We'll start with a traditional annuity. In our example, we will assume our retiree has fully retired and essential spending required is £5,000 per year. This excludes any state pension or DB pension scheme benefits. Assuming that our investor is 65 and that the level annuity rate at that age with no widow's benefit or escalation is 5%, it would cost £100,000 to buy an annuity that would offer a secure income of £5,000 a year for life. This has the benefit of being simple and easy to understand. It's also the cheapest way to secure that level of guaranteed income, but it comes with some challenges. For example, if our investor is diagnosed with a serious illness or marries, then the shape of the income may prove unsuitable for their needs. And should our retiree sadly die early in retirement, the £100,000 used to purchase the annuity would be lost. The alternative is a secure drawdown. Here, our retiree remains invested as they would with any other drawdown product. Every year they take a guaranteed income based upon their age when they started taking that income. If their savings run out, they continue to receive an income for as long as they live, no matter how long that is. In this respect, it operates just like an annuity. Let's look again at our examples of a 65-year-old retired man, as we did for a standard annuity. Let us calculate how much is required to secure the £5,000 of essential spending needed. Again, this excludes any state pension benefits or benefits from a DB pension scheme. Because the income rate on a secure drawdown product is almost certainly going to be lower than for a single life level annuity, we'll need to use more funds to secure the income. In this case, the income rate is 4.05%. That means that retiree needs £123,456 to secure that essential income, leaving £376,000 in flexible drawdown to cover discretionary expenses. However, secure drawdown comes with some extra benefits. Firstly, the retiree's savings remain invested. This means that if they die, any remaining savings would be payable to their beneficiaries. Secondly, the retiree can change their mind at any time and effectively transfer some of their savings back into drawdown. This would reduce their guaranteed income and any death benefits related to their investment, but could be useful if the retiree unexpectedly needed to access their savings if their needs changed in the opposite way and they decided to increase their secure income. They could transfer more of their flexible drawdown funds into the secure drawdown option. This may happen if, for example, their essential healthcare costs increased.
So let's get straight into some questions. Chris, what blend of products do you think clients should be using in Munich Freedoms?
I think it depends on the client. I think you've got a wide range of clients who are really diverse in terms of their needs. Many of our clients have alternative sources of income. They continue to work, or they've got rental property, and that has a fundamental impact on how we plan for them. But there is still a demand for having a guaranteed income in retirement. And I believe that many of our clients want that security of having a guaranteed income after working 40 years of their life and building that up, and building the pot up to do that.
I mean, Malcolm, this seems to be a recurring theme that the death of annuities has been greatly exaggerated.
Well, yes, that's certainly been my experience, as Chris says there, that people are looking for some sort of certainty throughout the years of their retirement. I was struck by one chap who said to me, I don't want to spend my retirement reading the Financial Times, with all due respect to the Financial Times, or worrying about ISA rates and things like that. I just want the money coming into me. And I said to him, well, that's an annuity, really. He said, well, I don't want one of those. Those are awful things, you know. And basically, as though it's almost a dirty word now, as annuity. And the other thing that the point he made, which I think is a good one as well, is that there is a worry about handing over the whole of your pot of money in the anticipation that you might die within 3 or 4 years, and therefore all that money's gone. So I think the two things that probably need to happen is, I would like to see a new name for annuities, like lifetime income plan or something like that. And secondly, something which is a bit more flexible, so people can feel a bit more confident that if at some stage something develops, that they might be able to get out of it or get their money back in some way, which would give them the certainty they might need to embark on an annuity in the first place.
I mean, that leads quite nicely onto a comment we've had from Nick, actually, which I'll put to you, Gavin. But he asks, do you think we will see new hybrid products developed in the annuity market to cater for those who want a degree of guarantee, but also some flexibility?
We're already seeing them. We've launched something that does exactly what Malcolm describes, which is gives that guaranteed income, but gives you the ability to encash it or dial it down. We're going to see more of that development. I'm aware of competitor products that are being brought to market. So we'll see a great deal more of that, because individuals want more than just a guarantee of income. They also want flexibility and access, and you simply don't get that with a standard annuity, even reflecting upon some of the announcements that we were talking about earlier in relation to being able to sell an annuity.
I think the interesting thing in terms of these new hybrid products is getting the balance right between being fit for purpose and making sure they're cost effective for clients. And my concern about this new market is the fact that new products will come out that will potentially do the job but become a really expensive solution for clients to transact with. In terms of calling an annuity a different name, I think Alan's probably the most appropriate name that we could call it. But yeah, I'm open to options.
Well, thank you for that, Chris. I think we've got time for just one more question, which I suspect might just need a one-word answer, but it's coming from Keith. He says, is the new state pension just misleading people into thinking they will be better off in retirement than they will be in reality? So, Malcolm.
Yes.
Yes. No disagreement there? Okay. So thanks to my guests, Gavin, Malcolm and Chris, for joining me. The fundamental aim of a pension remains to provide sustainable income in retirement. Only a lucky few have sufficient assets to know they will never run out of money, however long they live. For the rest, pensions are the only protection against penury in old age. And secure income, at a sufficient level to meet day-to-day living costs for as long as we need it, will clearly remain the bedrock of financial planning.